and welcome back everyone. Without any further detainment, we shall begin our second session as a part of our faculty development program on personal finance and investment, for which we have yet another astonishing speaker, Professor Dr. S. Santhosh Kumar. Now, Dr. S. Santhosh Kumar has a total of 21 publications in reputed journals like Scopus, ABDC, UGC journals of Rural Development Scopus, Indian Journals of Finance Scopus, ABDC, and many others. He has also many books published to his credit. He has got postdoctoral fellowship from ICSSR New Delhi in the year 2013. He has many research projects to his credit as well. Now, this session deals with the topic stock returns and risk analysis in Microsoft Excel. Now, I invite Professor Dr. Santhosh Kumar to lead the session. Over to you, sir.
Okay, thank you. Thank you very much for the nice introduction. Today we will be dealing with, since this is a faculty development program, the kind of experience each faculty member is providing to the students in front of you is important. So that is why, how can you give a real time or a good experience, a different experience in analyzing the stock return and risk. So the spreadsheet application will help you. Most of you may be knowing about it, but still this is those who are knowing about it can be considered it as a reminder exercise, a refreshing exercise, and those who are new to this kind of an analysis can learn something from this session. So our job is today's one and a half we will be doing how we can do or how we can compute the return and risk of an individual stock by drawing data, daily price data or weekly price data or monthly price data from Yahoo Finance or similar sites. And also, how can we compute the portfolio return and portfolio risk using this spreadsheet or MS Excel, how it is possible, how it can be done. So this, instead of giving ready-made 10-15 figures of risk and price data of some stocks to students, and when you do or when you isolate yourself from the real data, the kind of experience the students are getting may not be acceptable to them. So to have more acceptance as a faculty member, when you come up with real data, actual data of stocks, and when the computation of risk and return happens in a manner which can be applied in our daily life related to finance, that would be more beneficial. So our session today will be like this. First of all, we will compute using the actual data of a particular stock, the average return, the annual return, and the risk of that security or stock. Then when we talk about the return, the return can be simple return or log return, and in which way log return and simple return are different, and also which one can be considered as superior for analysis, what exactly the difference, and which one can be considered as superior for analysis and why. And then we will go for the computation of the portfolio return and also the portfolio risk. So for that, first of all, we will be downloading the price data for a year from the Yahoo Finance website. So I'm moving to, all of you can simultaneously do that. We can move to Yahoo Finance. Okay. So I'll share the screen. What do you see now? Hello?
So we see a browser. I mean,
Yeah. So what did I type there?
Yahoo Finance.
Yeah. So you can also do that.
Okay, sir.
Hope you are following, right?
Yes, sir.
Yeah. So I'm typing Wipro. Wipro Equity BSE. Click on that. So it will show the Wipro prices, the Wipro data. So there is a menu, historical data, right? All of you?
Yes, sir.
Yeah. So click the historical data. So it will show a default date is there, 1 year data is there, December 14 to 1422, December 1421. So historical prices, you can get historical prices, a dividend stock split or details are there. You leave it historical prices. And the frequency of the data, maybe daily data you get, weekly data you get, and also monthly data you get. We are sticking on to daily data. So if you give a download, okay, what do you see now?
An Excel
Hello?
file, sir.
An Excel file. Okay, this is a CSV file. This is a CSV file. So this file cannot be used for formula computation and so on. So what I am doing, I'm just copying down this data and pasting it to another Excel file wherein you could do computations. So I'm just opening an Excel file. So an Excel file is there, right?
Yes, sir. Yes, sir.
Yeah. So I'm copying the data. Control Shift down arrow will select the whole data. Control C will make a copy of it and go to the Excel sheet and paste it. Control V. Hello?
Yes, sir.
Yeah. So normally we do analysis based on the adjusted closing price. Closing price is the final trade price, but the stock split adjustment and dividend adjustments are done After having those adjustment, adjusted closing price will be published on a daily basis. So our relevant column is adjusted closing price. So I am deleting the other columns. This volume also we don't want now. So I'm deleting it. So my Excel file, there is the date column, which starts from 14 12 2020 to 14 12 2021. I think all of you have this data with you. So I am inserting one column here, sorry, one row here to give some title there. So this is Wipro. This is Wipro. Wipro adjusted closing prices there. Okay, we will go for some more shares later. Individual stocks return and risk. First of all, we will compute, and thereby, and also we will try to understand or distinguish the simple return and log return. Okay. So I'm going to find the simple return. The simple return. So yes, sir. Normally, return here means the price difference. Normally, hello, all of you. Return here means the price difference. Okay. So yesterday, the price was 100 yesterday. Today, the price is 110. So the return is 10, the difference. And the percentage of return, normally we can very simply say that yesterday it was 100, today it is 110. So it means 10 percentage. So how do you get that 10 percentage? That 10 percentage is equal to return divided by yesterday's price into 100. But you can make a shortcut for that. Okay, today's price divided by yesterday's price. Okay, what is today's? In my example, leave Wipro price. In my example, I said today's price is 110. Okay, today's price is 110, and yesterday it was 100, right? So what I am doing is equal to today's price divided by yesterday's price is equal to 1.1, right? Okay, so this minus 1 will give you the return. 0.1. 0.1 means into 100 is equal to 10 percentage. Not necessary to, if you want a percentage, you can convert it into percentage by having a multiplication or choosing the percentage cell. So this is called a simple return. So the formula for a simple return is this one: today's price divided by yesterday's price minus 1. So I am computing the simple return of Wipro. So I'm leaving the first cell because if you have to compute a return here, you want a previous cell. So you don't have a previous cell here. So the computation starts from here is equal to today's price divided by yesterday's price. Hope you are following, right?
Yes, sir.
Yeah. Minus 1 is equal to, this is a simple return. So the formula for computation of simple return is today's price, the short formula, today's price divided by yesterday's price. Okay, after division, you just minus 1 will give you the simple return. Okay, this is a formula. So simple return. So select the cell and double click here. When the cursor looks like this, a plus there, double click there, it will fill up or fill in the entire column. How many days data here? Any of the participant? Hello?
1 year.
1 year data, sir.
How many days data here? 250 days undo.
49.
നമ്മള് 3 നിന്നല്ലേ തുടങ്ങിയിരിക്കുന്നത് അല്ലേ? അപ്പൊ 248 ഡേറ്റ ഉണ്ട്, റൈറ്റ്? ഹലോ?
Yes.
Yeah. So we got simple return, right? Okay. And there is another computation which we call log return. It is a natural logarithm. It is a natural logarithm of these returns. So how do we compute it? If you want to find the natural logarithm of a number is equal to ln, okay, this ln. Okay, give the number, it will give you the natural logarithm. So we want a return, okay, like this. So we will find the return natural logarithm simply today's price divided by yesterday's price. That's all. Natural logarithm of today's price divided by yesterday's price. Okay, this is the log return. So if you want to fill in the return for the 248 days, click here, double click there. So the log return you got. So what exactly the difference between these two? Almost you may feel that somewhat same, but still we can distinguish between these two. Okay, suppose I am finding the return for the first 10 days. I am finding the return for the first 10 days. Okay, return for 10 days. Control C, Control V. Okay, so I am return for 10 days and just sum. Is equal to sum. Okay, sum this. So out of the first 10 days prices, you got the sum of the returns like this. When you drag this, you will get, you can just drag this, you will get the logarithm, the sum of the log returns. All of you, I have just computed the total of the returns for 10 days, simple return and log return. Okay, so I am just giving first day price is equal to, this is the first day price, right? Hello? 10th day price is equal to this one. Hello, following?
Yes, sir.
Yeah. If you have any issue, you please tell me. Participants, please. So what I have so far done, I have computed the simple return and the log return. Now we are trying to distinguish what exactly the difference between these two, which one is superior for security analysis, log return or simple return. Okay, that we are going to show. So what I have done, just for showing which one is more logical or which one is more logical for security analysis or superior for the security analysis or stock return and risk analysis. We are trying to understand what exactly the difference between this simple return and log return. So for that, I have just summed up or computed the total return for 10 days. Okay, so I have taken from this. Hello? Hello?
Yes, sir. We are
Yes,
following,
sir.
sir.
Yes.
Yes, yeah. So the sum is this. And I have taken the sum of the log returns also. So the first day price, then what I am doing, the first day price is 348 and the 10th day price is 381. So you can compute the return for 10 days from here by taking the difference in prices. So it is equal to, okay, instead of summing up, you can take the first day price and the 10th day price, then you can find the simple return from this using the formula. Return for 10 days is equal to, okay, 10th day price, this is 10th day price divided by the first day price is equal, sorry, minus 1. Okay, minus 1. So it would give you the return for 10 days. So remember, when you compute the simple return, when you compute the simple return by taking the first day price and the 10th day price, the return is this. When you computed the daily returns and you added together the 10 days return, what you are getting is this figure, right? Okay, now we are moving to log return. The log return, when you summed up or totaled the 10 days return, you got this figure. Okay, yeah, and This is the price, same. Sorry. So when you compute the log return for 10 days from the two prices, it is equal to ln 10th day price divided by the first day price. You see, both are this one and this one same, right? Hello, teachers, please. Hello.
Yes, sir. Yes, sir.
Yeah. When you summed up, or when you take a total of the return for 10 days, okay, in daily return you made a total, so the total is this. Okay, the formula is this. This one you totaled, so you got 0.091, 10 days return. And when you compute the log return from the first day price and the 10th day price, 10th day price divided by first day price, its natural logarithm, the natural log of 10th day price divided by the natural log of first day price is giving you the return 0.091. These are same. But in the case of simple return, you see this one, the 10 days total is coming 0.094, and this is coming as 0.096. Hello, sir. Sir, I will call you back. I'll, sir, okay, I'll call you back. Yeah. Okay. So you got, these two are different, right? Simple return. Hello.
Yes, sir. Yes, sir. It's audible.
Yeah. So it is different. So this here in the case of log return, it is same. This property of log return is called additive property. Additive property of this log return. So one of the superiorities or superior natures of this log return is this additive property, not addictive, but additive property. Okay, this additive property. So when you compute the price difference the first day and 10th day and take its natural logarithm and find the return, or if you take the daily return and you take its total, both would be same. But in the case of simple return, it may not be like that. Okay, one superiority is this property, additive property of log returns. Another one is when you come here, you have a distribution of simple return, and also you have a distribution of log return. This is a distribution. So when you check which distribution is closer to the normality assumptions, most all of us know it. Okay, so you can see that the log returns are more closer or meeting the normality assumptions. So whenever we go for security analysis and hypothesis testing later, this the distribution of return which would be closer to normality would be more useful than a distribution which less meet the normality assumptions. So these two reasons: one, the additive property associated with log return, and the distribution of log returns meets the normality assumptions. These two can be considered as the properties of log return, which is superior, which can be therefore be considered superior to simple return. Hope you understood. Hello.
Yes, sir.
Yeah. So now we come to the here we have 1 year daily data, daily returns are there. So from this we are finding the average return, average daily return. Okay, so the formula is this simple, is equal to average. So average is there. So give the numbers, the average of which numbers you need, you choose the number. So this is I'm leaving the simple return. I'm taking the average of this one. Okay, so control shift down arrow will choose the distribution. So I have computed, this is the average daily return. Average daily log return. Log return. Okay. Average daily log return. Yes. From this average daily log return, you can find the annual return. Average I'm not repeating the word log, average annual return. So you can annualize the average daily return. So what this is, the average daily return, average you computed from 248 data points. You have computed the average daily return, right? All of you?
Yes, sir.
Yes. Follow. I think you are following. You are with me.
Yes.
Yes, sir.
Yeah.
Yes.
Yeah. So we are annualizing it. The way you annualize it is equal to 1 plus the average daily return to the power of 248 trading days here, right? 248 trading days minus 1. Board, when board mass comes here, I think 1 will be minus last. So it is 80.85 means 85% is the annual return of Wipro, last year's data. So you can check, initially the price was 348 and it reached 600 and something by the end. Yeah, 645 or something. So this is the way you find 1 plus the average daily return to the power of number of trading days. Here it is 248, 250. Now you can use 250 if there are 250 trading days, minus 1. So 1 plus the daily average return to the power of number of trading days minus 1 would give you. So Wipro is this much, right? Average, Wipro's average annual return is this much. So now we are finding the standard deviation, daily SD. So standard deviation is equal to ST, standard deviation. When you type ST there, you will get a menu like this, drop down like this. From that, you select standard deviation. S means sample. So choose that. Okay, then choose the distribution. So the distribution from here, control, shift, down arrow will choose the entire distribution. So it will give you the daily standard deviation. This is the daily standard deviation. Okay, from this you can find the annual standard deviation, annual ST. Annual ST is equal to daily standard deviation into square root of, you type SQ. So you will get drop down like this, choose square root. Okay, square root of how many data points here? 248, bracket close. So daily standard deviation into square root of, if this was weekly data, you take square root of 52. If this was monthly data, so you will get monthly standard deviation. So monthly standard deviation into square root of 12. If it was weekly data, you will get weekly standard deviation. To get or to annualize the standard deviation, weekly standard deviation into square root of 52. Here this is daily standard deviation. To annualize the daily standard deviation, what you are doing, daily standard deviation into square root of how many trading days or how many days data there, it is 248. Okay, so you will get annual standard deviation 27% or 0.27. Hello, so far what we have seen is we have found from the daily data, we have found the log return, the daily return, we have annualized it, we have found the daily standard deviation we have found, and we have annualized the standard deviation using the formula daily standard deviation into square root of number of data points here, number of trading days here in a year, normally 250 or something, because we have taken 1 year data. So that 1 year data is giving you 248 data points, simply means 248 or 249 days, no problem. Yes. So we have computed the return and risk of a single stock. Hello?
Yes, sir.
Yes,
Yeah.
sir.
Shall I move to a portfolio?
Yes, sir. Yes, sir.
Yeah. So I'm just copying Wipro. We can download 2 more stocks. So let me copy this, Control C. I'm opening another sheet here. So Control V, I'm pasting it. So Wipro is there. Now we are going for, what do you see now? Yahoo Finance?
Yes. Yahoo
Yeah,
Finance.
Yahoo Finance. So you type here, Reliance Industries Limited. Yes. Yeah, Reliance Industries Limited. So historical data there. So daily, the frequency is there. The frequency daily, the same date, December 14, 2020 to December 14, 2021, the previous data. So same for the same period, we will get, if you download, you will get the Reliance prices. So give download here. Opening the Reliance prices. Yeah. So just copy down, Control Shift down arrow, the adjusted closing price only, Control C, then move to our Excel file. Okay. Control V will paste it there. This is Reliance. Yeah. So we can go for one more stock to be included in our portfolio. We know that portfolio is combination of securities, and we don't put all our eggs in one basket. We will go for portfolios or diversification. Why? Through diversification, what we are trying to reduce the risk. So to what extent risk can be reduced? If you could choose perfectly negatively correlated securities or stocks into your portfolio, you can reduce the risk to zero, even zero. So the portfolio construction, the fundamental rule is choose negatively correlated stocks or less correlated stocks at least. Okay, so we are going for another stock. This is a random selection. Going for another stock. You see Yahoo Finance here now, right?
Yes.
Hello? Yeah.
Yes, sir.
So I am downloading, I am taking Infosys in Infosys there. Infosys BSE there. Yeah. So historical data, make a download. So this is Infi. So you choose the adjusted, select the adjusted closing price, Control Shift down arrow, Control C will copy it. Choose the Excel sheet. So paste here, Control V, it will give you the adjusted closing price of Infi there, Infosys. So we have the adjusted closing prices of 3 stocks here, all of you. So we are computing the log return, Control C, Control V, I'm just pasting the label. So LR, log return, we are finding out. So we are finding out the log return. So leaving one cell, you are putting up here. What is the formula for computation of log return? Hello? Hello?
Yes, sir.
Is equal to ln today's price, Wipro's today's price divided by Wipro's yesterday's price. Yes. So this is the log return. So if you drag, you will get the first day return of Wipro, Reliance, and Infi. Okay, if you double click here, you will get the log return of all the three stocks. Could you simultaneously do this? Hello?
Yes, sir. We are doing
Yes,
it.
I'm doing.
Yes, sir.
Yeah. Are you with me or
Yes, sir. That's why we are not able to switch on our mics and talk to you.
yeah, okay, continue please. Yes, okay, it's all right. Yeah, so here what we have done, we have computed the individual log returns. So I'm copying, Control C, just for Control V, just the label I have copied. So we are computing the average daily return. Average daily return is equal to average is here. So first of all, we are computing Wipro. You have to choose the data points, Control Shift down arrow, enter. Control Shift down arrow, enter will give you the average daily return of Wipro. So just drag this, you will get the daily return, average daily return of both Wipro and Reliance. Sorry, Reliance and Infi. So from this, you can find the annual return. Annual return. How do we annualize it? We know is equal to bracket 1 plus daily return, bracket close, to the power of 248 minus 1. Compound, we are just compounding it, that's all. So this is the figure we got earlier, right, for Wipro, right, 85. So if you drag this, you will get the annual return for, it is very easy. The annual return for a other stocks also. So now we are finding the average daily standard deviation, average daily SD is equal to ST, standard deviation of sample, choose the data, Control Shift down arrow, enter. So average daily standard deviation is there. Drag it, you will get the standard deviation of other stocks also. So you have to annualize it. Annual ST is equal to daily into square root of trading days, 248. 248. So if you drag it, you will get the annual standard deviation. So I'm talking about a portfolio. Hope you have done up to this point. If not, I will wait for you, because now we are moving to the computation of portfolio return and portfolio risk. If you give me a feedback, I will go for its computation. Otherwise, I will wait for you to get up to this point. Control C, Control V. Yes, I'm talking about a portfolio.
Yes, sir.
Yeah. May I continue?
Yes, sir.
Yeah. Dr. Smriti? Hello?
Yes, sir.
Yeah. So we are computing the portfolio return. Before that, I am giving you a portfolio proportion, PROPORTION. I have rupees 100 in my hand. I've committed 50 percentage in Wipro, 25 percentage in Reliance, and the rest 25 percentage in Infosys. So this is the proportion portfolio, right? Okay, 50 percentage here. So what I am looking for, I want the portfolio return. Portfolio return. Okay. Portfolio return is a weighted average of, it is a weighted average of individual stock returns. So these are the individual annual returns. These are the individual annual returns. It's weighted average. Weighted average means 50% into Wipro's annual return plus 20% of Reliance annual return plus not 20, 25. 25% of Reliance annual return plus 25% of Infosys annual return. That is a weighted average, right? Weight into annual return. You sum. So weighted average is equal to sigma I is equal to 1 to n Ri into Wi. We have studied the theory part. I am not explaining how the computation is done, and the weighted average is simply, or you can say that take 50% of Wipro's return, take 25% of Reliance return, and 25% of Infosys return. Okay, then I add together, add it, sum it, you will get the weighted average return. That is the portfolio return. So here we can compute the portfolio return. Portfolio return is equal to this proportion into this is annual return. So you can put it in a bracket. Plus this 25 into this return. This can also be in bracket. So simple. It is just multiply. Plus this one into this one. So you are taking the weighted average of the individual stock returns to find the portfolio return. So it is, the portfolio return is 0.61 or 61%. Hello? Hope you are following.
Yes,
Yes,
sir.
sir.
Yes, sir.
Yeah. So portfolio return, okay, right? All of you? Portfolio return, I think it is okay for you.
Yes, sir. Yes, sir.
Yeah. It is portfolio return. Now we have to think about the portfolio risk. Portfolio risk. Portfolio risk computation, we cannot do like this. You cannot take the weighted average of the annual standard deviation as the portfolio risk. The portfolio risk, you have to compute how the securities involved in the portfolio are interactive, the interactive risk when the portfolio changes. So its computation is bit difficult or bit confusing than the straightaway computation of portfolio return. It is simply the weighted average. So you cannot take the weighted average of annual standard deviation as the portfolio risk. So I am explaining step by step. The theory part you read it from the different books. You may be knowing, all of you may be knowing. Yeah, but in the spreadsheet, how can it be calculated? How can it be calculated? Okay, so first of all, you have to have a one by one I am explaining. You have to make a variance covariance matrix. A variance covariance matrix. So I am merging this variance, better call it covariance variance matrix. Covariance variance matrix or covariance variance. Okay. So what I'm just giving a label here. Copy, Control C, Control V, paste here. And here also you can paste here, Control V, no, undo. Yes, Control V, choose here, you give a transpose so that it will be pasted like this. Okay. So what I'm going to do here, I'm going to find the covariance Wipro and Wipro, that is variance. That is why it is called covariance variance. What is a co-movement in the return? Okay, when the portfolio changes, what exactly the co-movement? Wipro and Reliance, Wipro and Infosys. Okay, that we are going to find. So this cell, so we have to fill in, we have to find or fill in these cells, 9 cells. Each one you have to find the covariance. So what you can do, covariance, you can find it from the data tab. I am not going for that. Just you compute here is equal to covariance sample. So you have to choose here in that cell Wipro, right? All of you? Wipro return to Wipro return. What exactly it is variance, it's not covariance. Okay, so choose the data, Wipro return here, Control Shift down, enter. Okay, what happened? Covariance. Control Shift down. Wait. What happened? Some troubleshooting. Sorry. Control Shift down. Oh, some issues there. Maybe there you give better variance. Maybe variance, that may be the variance sample. Okay, then you choose the data, Control Shift down, Yes. Okay. Variance. That is because this Wipro and Wipro, both the data are same. It is variance. That is why I have written covariance, variance matrix. Hope. Hello. So this column is this column is equal to covariance sample. So this is Wipro and Reliance. So first of all, you choose Wipro, Control Shift down arrow, comma, Control Shift down arrow. Then you have to Wipro you have chosen. Now what you have to choose? You are finding the covariance of Wipro and Reliance. So you have to choose Reliance, Control Shift down arrow, enter. Will give you the covariance of Wipro and Reliance. Similarly, you find the covariance of is equal to covariance, the covariance sample, covariance of Wipro and Infi. So Wipro here, Control Shift down arrow, comma, then Infi is this, Control Shift up arrow, yes. Sir, I will call you back. We're meeting. Okay. Yes. So did you get hello covariance? Hello, all of you?
Yes, sir.
Yeah. So I'm preparing a covariance. What exactly the covariance between the returns of two stocks, right? So this is a covariance variance matrix. So here you are finding Reliance Wipro. Okay. So Reliance Wipro is here. You can copy down this or you can find out fresh is equal to covariance sample. So Reliance and Wipro. Okay. So this is Reliance, Control Shift down arrow, comma. This is Wipro, Control Shift up arrow. Yes. So same. This one and this one same, right? So Reliance, it is variance is equal to variance. So you choose Reliance, Control Shift down arrow, comma. Again, the same thing, Control Shift up. Same. I have just done the selection from the bottom. Okay, you can do anyway. So it is, this is Reliance, and this is Reliance Infi. It is covariance is equal to covariance. So it is Reliance Infi. Reliance this, Control Shift down arrow, comma. How to give the formula will be displayed there. Okay, covariance, array 1, array 2. Array 1 we have given, it is, what is that? It is Reliance. So Reliance to Infi we are finding. So you choose Infi, Control Shift down arrow will give you Infi. Okay, so the covariance you got. So here it is covariance between, tell me, Infosys and Wipro, right? Hello?
Yes, sir.
Yes, sir.
Yes, sir. We are following,
Are
sir.
you following?
Yes, sir.
Yes.
Yeah. Okay, we have just 10 minutes more, right?
Yes, sir.
Yeah. May I continue?
Sure, sir.
Yeah. So covariance, Infosys and Wipro. So control shift, select the first cell, control shift down arrow, comma. Then you want, oh, I forgot which one was there. Info and Wipro, right? So Wipro you choose, control shift down arrow, enter. So Wipro covariance you got. So here, sorry, Infosys Wipro you got. So here it is equal to Infosys Reliance. So is equal to covariance. So Infosys Reliance. You can choose control shift down arrow. And that is not possible. Array 1 and array 2 you have to give, right? So it is covariance. So Infosys and Reliance. So Infosys, control shift down arrow, comma, Reliance. Reliance is this one, control shift up arrow. So enter. So here it is infi. So it is variance is equal to variance sample. So it is infi. This one is infi. Control shift down arrow, comma. Same infi you have to. Both the arrays are same. Control shift up arrow, enter. So we have got a matrix. We have got a matrix which we call as, which one? Tell me. Variance.
Variance, covariance matrix.
Yeah, variance covariance matrix. Yeah. So with this, I am giving. We want, first of all, what we would be computing. We will be computing the portfolio variance. Portfolio variance. Then you take the square root of portfolio variance. You will get the portfolio standard deviation. So how do we compute the portfolio variance? Remember, in spreadsheet, I'm giving you the shortcut. Okay, this is the proportion, right? All of you, this is the proportion. Okay, this matrix into this proportion or this weight into the product of covariance variance into the proportion. Okay, so I'll tell you what exactly it is meant. So remember, this proportion I am copying. I'll tell you why it is. Control C, and I am pasting it as a 1 into 3 matrix. Control V. I'm transposing it. The same one, the same proportion. Okay, 3 rows and 1 column. Here 3 columns and 1 row. Why it is, I'll tell you later. So now we are finding out the portfolio variance. Portfolio variance. Portfolio variance is equal to, we are going to multiply the matrix. Okay, you see which are the metrics we are going to multiply. Okay, so we are choosing an Excel function MULT, matrix multiplication. That is a function. Okay, so it is very easy. If you have this data with you, it is very easy. So what you have to do, you have to first choose the proportion matrix, which is in this form. Okay, so this one, proportion. Okay, comma. So one matrix you have chosen. Okay, one matrix you have chosen. 1 into 3 matrix you have chosen. Then again this matrix is to be multiplied with the product of covariance, variance matrix and the proportion matrix. Okay, so again a matrix multiplication is there, MMU matrix multiplication. Okay, so you are multiplying the first matrix into, okay, with the product of another two matrix multiplication, which is that, okay, that is this, okay, this covariance variance matrix, okay, comma, into, okay, into the weight here, because there is a rule. If you have to multiply two matrices, what do you have to do? The number of columns in the first matrix should be equal to the number of rows in the second matrix. So here the number of columns 3, right? In variance covariance matrix, the number of columns 3. So the second matrix for multiplication should have 3 rows. Okay, that is why I have made another matrix here. So this is the way you will be doing. So you choose this matrix. So close it. Okay, so when you close it, remember, when the formula is complete only when the last bracket is black in color. So give brackets until black appears. Yeah. Okay, so what I have done here for portfolio variance, simple. I have multiplied the proportion matrix into, multiplied the proportion matrix with the product of covariance variance matrix and the proportion matrix. Okay, so it will give you the portfolio variance. This is the portfolio variance. So you have to find the portfolio standard deviation. Portfolio SD standard deviation is equal to square root of this variance. So it is, this is the portfolio standard deviation. This is the portfolio standard deviation. Okay, so remember, you just listen to the standard deviation of the individual stocks: 27%, 25%, 20%. Okay, when you club together with different less correlated assets, the portfolio standard deviation has significantly reduced. This is the power of diversification. This is the power of diversification. So I will explain you the calculations for a portfolio return computation and portfolio risk computation. First of all, you choose individual stocks, find the individual returns. Okay, it can be weekly return or daily return, weekly return or monthly return. Annualize it. So when you have annual standard deviation and annual return with you, you can go for the computation of portfolio. Think about a portfolio. Here I have just given 50% of your investments are in Wipro, rest 25%, out of the rest 25% or 50-50 or equal in Reliance and in fee. So this is a proportion. You can have a proportion like this, any proportion like this. Okay, 10% in Wipro, 80% in another, 10% in the other stock. So this way, the weighted average of the individual stocks will give you the portfolio return. And from the portfolio, after finding out the portfolio return, you have to go for portfolio risk computation. For that, first of all, you have to make a variance covariance matrix. Okay, it is simple to make a variance covariance variance matrix. Then just multiply. You can find the portfolio variance by using this, by using matrix multiplication. What I have done, I have multiplied this matrix with the product of this matrix and this matrix. Okay, I have taken the product of these two matrices and multiplied it with this matrix. Okay, it will give you the portfolio variance. From the portfolio variance, you find the portfolio standard deviation taking the square root of the portfolio variance. That's all. Okay, Dr. Smriti.
Smriti ma'am.
Yes, sir. Yes, sir.
Yeah.
So,
I think I have stick on to the time, right?
yes, sir, you have.
Yeah.
Thank you so much.
Might have been you might feel some speed because we have to cover up. Otherwise, we have to stop in between. That's why. Yeah.
Yes, sir. Thank you so much, Dr. Santhosh Kumar, sir. It was truly very informative, and the technical knowledge regarding the stock returns will definitely enhance the researcher's vision. Thank you so much, sir.
Okay, it's all right. Participants, do you have any feedback, or do you have any clarifications? If you want, I think you have your time for a validatory session. Hello.
Yes, sir. We have it by 3:30, sir.
3:30. Okay, okay. Let me leave. Okay. May I leave?
So would you like to be a part of this validatory session?
No, because I have some other engagements. Okay. I think you have enough audience and also dignitaries for the function. Okay. Let me leave. Yeah.
Okay, thank you, sir.
Okay. Thank you for the patient listening.
Thank you, sir.
Thank you, sir.
Thank
Yeah.
you, sir.
Thank you. Yeah.
Thank you, sir. One more request. Please share that Excel so that we can.
Yeah. Oh, that I will do. Yeah,
Okay,
I will
sir.
share to Dr. Smriti so that she will share among you. Right. Thank you. What's
Okay,
your
sir.
name? Your name, please.
Sir, I am Vishwan. Sir, I am Vishwan.
Oh, okay. Vishwan. Okay. Thank you.
Okay,
Yes.
okay, sir. Thank you.
Gopika, miss, shall we start?